Welcome to Oregon Cash Flow Pro. My name is James Barber, and I'm here to help you maximize your cash flow. I'm going to go over a spreadsheet I made up here for one of my clients. We're looking at insuring him, his wife, and his family, and he's got 5 kids. So what we're looking at is we're trying to figure out what is the best way to distribute these life insurance policies for cash value growth and also return on investment in the long run. So I put together this spreadsheet. I'm going to share it with you so I can send it to him and he'll be able to reference this video. So let's get into it.
Oregon Cash Flow Pro offers free money management advice to help you take control of your finances. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
So our columns here, we've got the husband, the wife, 19-year-old daughter, 18-year-old daughter, 16-year-old daughter, 14-year-old son, and a 9-year-old daughter. Now their goal was if they put $200,000 a year into the policy, we've got a couple of different options. Option 1, $75,000 a year for both parents and $10,000 each for the kids. Or option 2, $50,000 each for the parents and $20,000 each for the kids. So I've got a few columns here. This is the death benefit for an optimally designed policy, an infinite banking policy design for each of these insured. We have our break-even year. That's the year that they will have greater cash value than they've paid in premiums. Then we've got cash value in year 20, cash value in year 40, and then also what would the cash value be at age 40 for the insured. This one's the only column that is apples to apples at age 40. The rest of these at year 40, they're all going to be different ages. And so you're going to see 40 years after the policy starts. So not just at age 40, which is this next column. So that's the difference between those two columns. Now in this, we just repeat these same columns. We have the death benefit column, break-even year, cash value in year 20, cash value in year 40, and then at age 40. You can see the stars here because they are already over age 40. Now, how does this all break down? In option 1, we have $9.8 million in life insurance, death benefit total. And in option 2, we end up with $13,400,000 in death benefit. Now this is year 1 death benefits. The death benefit will actually go up over time after they hit their break-even period and the term insurance drops off. The term insurance that we blend into these whole life policies. Once that drops off, the death benefit is going to continue to go up as cash gets added to the policies. Now, cash value in year 20, you can see we've got $3.2 million if we go with option 1, $3.4 million for option 2. So it appears within 20 years, if we're just going off of cash value, you're better off putting more cash into the children's policies. Cash value year 40, total $7,581,000. Cash value year 40, $8 million for option 2. So we're about $500,000 plus higher in cash value by year 40 if we go with option 2 and we put more cash value into the children's policies, less into the adults' policies. Now, since we're trying to maximize our cash flow, my next thought was, what about with the death benefit added in? What happens if year 40, the parents have passed away, or year 20, the parents pass away. Because the reason we might consider putting more money into the parents' policy is because they're going to have a higher death benefit and they're going to pass away sooner. So if they're going to pass away sooner, that death benefit is going to be available to the kids tax-free. So what I plugged into our spreadsheet here is, down here we've got death benefit in year 20. This is the husband's death benefit, what it's grown to, and this is the wife's death benefit, what it's grown to. And if they passed away, the cash value in year 20 for all the kids' policies, plus the death benefit they would receive if the parents passed away, our total is $6,300,000. So this is using option 1. Option 2, same situation, lower death benefit for the parents, higher cash value for the kids. Our total after year 20 ends up being $5.5 million. So if they're going to pass away within the next 20 years, they're going to be much better off, $800,000 better off, going with option 1. However, this is a pretty healthy family. The adults are healthy. There's not much that we can point to that says they're not going to live well past the next 20 years. So let's see how this does at 40 years. If they pass away in year 40, this puts them at 83. And for every year that goes up higher than this, the results are going to, well, my guess is they'll lend more to option 2, but we'll go over why. So death benefit in year 40 for the husband, death benefit year 40 for the wife. Option 1, cash value if the parents passed away in year 40 and the death benefit paid out. So cash value of all the kids' policies plus the death benefit from the parents would equal $9.35 million. Option 2, here's our death benefits for the parents, quite a bit lower. At the cash value in the kids' policy is quite a bit higher. So we're at $9.26 million. That's only $100,000 less than option 1, and that's if they pass away. So if they're going to be passing away, so if we're trying to guess here at how long they're going to live, I think our guess is they're going to live past age 83, which means these two numbers, 9.2 and 9.3, those are going to get closer, and at some point, option 2 is going to surpass option 1. At 40 years, though, we're still at option 1 as being the better option by $100,000. So I would think only in the case that it's a high likelihood that they're going to live past age 83, then we would want to go with option number 2. They're still going to have a lot of cash value to work with using either option. So this is going to be something that is situation dependent. I'm not going to recommend one or the other, but they're going to have to decide which way do they roll the dice. Do we go for our longevity and look at how old we would have to be? I'm going to have to crunch some more numbers because I'm going to look at how old would they have to be before these numbers flip-flop, because I think that would be good to know. The only problem is that's a lot of number crunching. I had to do 14 different policies just to do these spreadsheets. I had to do 14 different illustrations, play around with the numbers, and then copy the information over. So it's a bit intensive, but I think it would be good to know when the actual break-even period, that'll give them the most information with which to make this decision. So I will work on that, and in the meantime, he'll have this information to digest. I'm sure it's a lot of good information with at least how he wants to begin making his decision. So that's it. I just wanted to share that with you guys, this neat spreadsheet that I made and the situation that we're looking at, because I found it fascinating, the difference in how you can allocate $200,000 between family members and how it can make a difference. One of the things that you'll notice if you're looking at this spreadsheet is how the cash value tends to go down for the kids as they get younger. And part of that reason is health ratings. So if juveniles only qualify for non-tobacco ratings, so they don't get the preferred rating that you can get after they turn 18, after they become adults, and they have access to more medical records and they can do more extensive medical tests. For juveniles, they don't get into all the medical testing that they do for adults. They just look at medical history, and because of that, they don't go with any better health rating than non-tobacco, standard non-tobacco. Anyway, check it out. If you have any questions about the spreadsheet, put them in the comments section below. I'll answer what I can while keeping people confidential. And I look forward to hearing from you. If you found value in today's video, hit the like button, subscribe to the channel. If you want to see more of things like this, we'll talk to you soon.